The market is great. No, it's not. It's about ready to crash. We have a clash going on right now in real estate where there's two camps where one group would say, hey, everything is fine. It's all good. I told you the market is really competitive. And then others would say, yeah, but have you looked at the future? It almost feels like someone coming to the table and saying, hey, I have some exciting news. I just got married. And then someone would turn around and say, well, have you looked at divorce stats lately, though? And so that's not the perfect analogy, but there's this dynamic where it's hard to talk about the competitive market today without, dismal news coming into play. And that makes sense. That's sort of the market we're in. I mean, there's so much to think through. And so I'd really say that there's two markets, and we have to be real about what's happening in the present market, and we have to look to the future and go, what might happen in the future? And so it's good to consider both. And in today's video, what I want to do is I want to talk about the current market as well as the future. And I'm going to start with the future and look at some of the red flags and some of the things that we really need to watch out for. And then I want to unpack the local market in depth, okay? And this isn't sensational, this is objective data and perspective. And I hope you like this. This is Ryan with SacramentoAppraisalblog.com. This will be about 20 minutes. Let's jump in together. So, one of the big factors, as HousingWire.com reported this week, was that 8.8% of US mortgages are in forbearance. And so this is absolutely astounding. And as the article noted, that this number is expected to go up to about 10% or possibly 11% in the next couple months. And so that essentially means that 1 out of 10 mortgages are not being paid. And so this is a ginormous issue, and we're not sure exactly how this trend will play out, but it certainly could lead to a lot of properties being listed in the future, or if they're underwater in their mortgage, some short sales. The most vulnerable population here would be buyers who put little to no money down. So my understanding so far is that FHA loans, for instance, have a greater rate of forbearance. But you can look at other factors. Bloomberg announced U.S. retail sales fell by 16.4% in April. That was a brand new record. Other gloomy news that industrial production and manufacturing was down over 11%, and this broke the record from over 100 years of data. All right, locally, we have our Governor Gavin Newsom is saying that we are going to have state workers take a 10% cut. And so this idea is maybe going to start in July, but that's really astounding because in Sacramento, the state is by far our number one employer. All right. In fact, the Sacramento Business Journal says that the region has 78,000 state workers. And so it's very sobering to imagine households that will be taking a 10% cut, or imagine a household like the Sac Bee article where the man that was showed where he and his wife worked for the state and they're going to take a 20% cut. And so this is a very big deal for the local economy. All right. One of the other X factors is the unemployment rate. In black, since 1990 is the United States unemployment rate. Last week I talked about it shooting up. Okay, for April it's at 14.7%. And Sacramento County in California are poised to also have an astronomical unemployment rate. Okay, I was talking to a seller this week. I did some consulting with the seller who's overpriced. And one of the things that I mentioned to the seller is May 22nd will be the date where unemployment data is released for California and Sacramento County and all surrounding counties. And I said, buyers are very sensitive to paying the right price right now, but you have to realize that bad news or gloomy news about employment or state workers being furloughed or potential job losses, that can get in the psyche of buyers, and so that could infuse buyers with more uncertainty. Okay, that's not guaranteed to do so, but this will surely have an impact on some. All right, and so you want to get it priced right now. Okay, that was my advice. But really, when backing up, price cycles are normal on real estate. It's the most normal thing ever for prices to go up and for prices to go down. What's not normal is that sometimes when our real estate narrative says that, the market's always good, it's always going up, and, things will go up forever and we'll, dance on rainbows and ride unicorns. No, that's not how the market works, okay? And so in this graph, you can see from 1975 through 2020, this is a Freddie Mac price index. And any time in red was when the market was down. And so can you see that cycle? And would it look normal at some point for the market to go down? Yeah, I think so, right? And so there's no guarantee that any future downtrend would happen soon or that it would be anything like it was in the past, okay? What it was in the past was a real anomaly, but at the same time, I think we have to concede. I mean, we're in an anomaly of a market right now, okay? But we'll see how it pans out. I'll say that it's a little bit like being pregnant, though, and I'm sorry I'm saying that as a man, but it's sort of like we have all this stuff that's happening right now. Eventually, we're going to get the result in many, many months from now. Just like a pregnancy, you'd get the result of a child. And so, but right now we have all that this is happening, unemployment and forbearance and, state government, workers taking a pay cut or some being furloughed. And we don't yet know what the result's going to be, but we're sort of waiting and we know that there's this trend. And so we have to keep waiting and watching and being objective about stats as we look at them. So now let's look at current market trends. I want to unpack this deeply. I hope that you found value so far. If you did, please like this video. I'm working hard for you guys. I'll put something out once a week. So here's new listings in the Sacramento region. They were increasing until about mid-March where there was a sharp decline when the coronavirus hit, okay? And then, we've really seen for about 6 weeks now where we've seen more listings consistently, okay? In fact, this past week, there were 652 new listings, and that was up from the previous week, but most notably, it was the highest week since the pandemic began. Okay, and so it just shows that sellers are getting used to this market. More sellers are coming to list their homes. And if they feel safe, I've been telling sellers it's a good time to get your property out there because there are a lot of eyeballs out there right now. Okay, but I'll note that we're down 8.9% from when the pandemic began. And so, we still have a ways to go. Theoretically, it could take, a few more weeks or so until we pass this level. But I will say that this week we were down 204 listings from the same week last year. Okay, so we're down 24% from where we should be. Okay, really week by week we've been down anywhere from 30 to 40% some weeks too. And so we have a ways to go. Here's weekly pending contracts, and you can see a similar dynamic. They are increasing, and there's a sharp decline when the coronavirus hit. And for about a month and a half, we've seen pendings increase. Okay, except I'll say this past week, pendings were down slightly from the previous week. Now, it's going to take in the next few days, this data will be refreshed, and I believe that we'll probably have, 570 or so pendings. That's very similar, so I would call this pretty flat compared to the previous week. But we're down about 10.6% from the peak, from the pre-pandemic peak. And so presumably if this starts to increase, maybe in the next couple of weeks, we'll get back to where we were. Here's a different way to look at that, a sharp decline, and then week by week, we're seeing more pending. So here's the interesting part to me, that a few weeks ago, there was hardly any difference between pendings, one week to the next. And then this week, once we refresh this data, it'll be down just a little bit most likely. And so it just shows that the market isn't the same every single week. We're not going to see exponential growth every week, but we do have to sort of gauge demand and wonder, well, how many buyers are out there and what will these numbers look like in coming time? Even though sort of the market bottomed out and we've seen this recovery, what do the next weeks bring and what do the next 2 months bring? Here's an X factor. We ask how strong is demand. And so here are weekly pendings in orange and then weekly new listings in blue. And it's very normal in a market to have more listings and pendings. There should be that. Okay, the market like about a month ago was a little too competitive because we had literally more pendings than we had listings. Okay, that's not normal. But what we want to watch is this gap. If this gap starts to widen, then we would go, okay, then buyers are gaining a little bit more power. All right, but we're going to be tested in our market. How much demand is there? And if we're missing hundreds of sales right now each week, could our market handle, hundreds more buyers, or could our market handle 200 more listings this week if we had a normal year? That's a good question, and I think we'll know the answer as time unfolds. Don't overprice. So Sellers, please, please don't overprice, but especially during a pandemic. Okay, I actually made this sign this week. I love woodworking. If anyone wants this, comment below and I'll make this available. You have to pick it up from me, but this is about 10 or 12 inches wide, so kind of a fun thing. Maybe it'll look good in a real estate office or something. But here's a weekly hold statuses. I've converted most of my data to weekly. I hope you like it. I think that's the way to go. But when you look at weekly holds, they're a little bit higher than they were before the coronavirus pandemic began. And it's a similar dynamic with cancellations. They're just a little bit higher than they were. Now, cancellations have been, I think, I'd say a little bit closer to pre-pandemic levels than the holds. Okay, and so let's continue to watch these. But there's been 1,659 canceled or hold listings since March 12th, since our coronavirus day. And many of these properties are poised at some point to come back to the market when sellers feel comfortable. Now, of course, if some of these were state workers or people have lost jobs or confidence or whatever, wherever they're at, maybe they won't come back. All right. Here's all the data I just shared in a table, and you can pause the screen and really, parse this if you want. But I just want to say that these graphs are available. If you need them in image format, please send me an email and I can send you the latest stuff I have. You're welcome to share on social media and in newsletters. I just always ask, give credit where it's due. But let's talk about prices and sales volume, a few other dynamics, and then we'll close this thing up, okay? So here's a weekly median price in Sacramento County in blue. And you can kind of see that by the week, it is all over the place in 2020. Okay, and then 2019 in red, 2018 in green. And so, we have to be careful about giving too much weight to weekly listings because if we're looking by the week, we're going to be schizophrenic and saying, no, it's up, it's flat, it's down, no, it's up again. But really, why I'm looking by the week is because I want to get a preview with what monthly data might look like. Okay, I give way more weight to month by month. And in Sacramento County, the median price was 400 in March and then 400,000 in April. And so it's been very flat. And the weekly median price has been more or less hovering somewhere between 395 to 400 or so. All right, now here's the region. And the region's interesting in 2020 because it definitely has taken a little bit of a dip lately. Okay, and I'll say the median price for the month of March versus April went down 1%. Now, it's not normal to see that sort of decline from March to April. Okay, the last time the market showed a dip from March to April was 2014. Okay, but I will say that it does happen at times. But overall, it seems week to week that we're trending down, and we'll see sort of where this heads. And again, don't put a lot of stock in just this weekly median trend. We always have to ask also, is it subdued because there's less numbers? Sometimes when we have less data, it can lead to some wonky stats. Or is it down because we're having more sales at the bottom of the market? And again, that's sort of something that we're going to be exploring over time to understand what do these numbers mean. All right, but for now, week by week, I'm watching, and that's the best available information I can give to you for now. Now, let's look at sales volume and then a couple other things. So, sales volume, there were basically 319 sales compared to 595 the same time last year, the same week. And so that's down 46%. There were basically 276 less sales. And so that's kind of what I'm talking about demand. Can our market, as we return to normalcy, so to speak, as the pandemic slowly improves, hopefully in California sort of opens up a little bit more, are we going to experience more normalcy or not? Can we make up for about 300 more sales each week? And that's what we'll see over time. A lot of people have been asking me about the 2 to 4 unit market, and here's how I'm gauging it from January, February, March, and April. 2019 is in blue and 2020 is in yellow. And you can kind of see that over the past couple months, 2020 has been lower. Now, it makes sense to see less volume overall because we're in a pandemic, all right? The single family market, showed a huge dip. I'm not surprised to see the 2 to 4 unit market showing the same. But what we want to gauge is, okay, is the 2 to 4 unit market, is it doing better or worse than the single family? Okay, and let's realize that we also have rent control brand new in 2020, and how is that affecting the market? And is that part of the stats here? And so, again, this will be more meaningful in a few months, but it's something I'm starting to pay attention to. One thing to consider though about the two to four unit market is that most of these owners are actually, individual investors. Here's a cool graphic put out by Harvard University. Granted, this is 5 years old, but I think it's powerful data. And it shows that, among the 1 to 40 unit market, that about 75% of these units are owned by individual investors. And so I know it's really popular to destroy investors online, but I would say for the 1 to 4 unit market, that a lot of these investors are mom and pop. Maybe they just own that one property. Maybe if they're lucky, they own a few. And so what we have to watch is that, okay, if renters stop paying rent, then how does that affect the individual investor? Okay, we're not talking about Blackstone owning 1 to 4 units here and dominating this market. And so it's definitely something to watch. Okay, one thing that happened this week was Jack Dorsey, the Twitter CEO, he said that his employees can work from home forever. And so we want to just watch how this affects sort of the market, and can we have more Bay Area transplants in Sacramento? And then also, how do listings change? Do we begin to highlight the idea of the home office more, especially if we presumably see more companies follow in suit? Okay. But here's a different way to look at volume. One of the things that I'm asking is, what's the difference? Are we seeing a difference in, at the high end versus the low end? Because again, we want to gauge different price segments and go, hey, how's the market moving? Okay. And so let me explain this image. It basically compares April 2019 with April 2020. And when you look at all sales, they were down almost 32%. Okay, but you can look at the $1 million market, and the $1 million market, there were almost 39% less $1 million sales this year. Okay, and then it goes on and on by price range. And this graph is not all that meaningful for 1 month, but what I want to do is over the period of the next 3 to 4 months is to show these together, and just so we can really gauge, okay, how's the market changing in various price segments? Okay, but one thing to note, look, the most aggressive declines in sales volume came under 300,000. And it's tempting, I know, to look at this and go, oh my gosh, the market under 300 must be slumping, but that's actually not it at all. Here's the deal. There are very few sales under 300,000. From last year to this year, this sliver of the market has shown probably the heftiest increases in price. And so, like a friend Denise said this week, she said, under 300 is like a unicorn right now. Okay, it just hardly exists. And so these, I would say, take these with a grain of salt, but just know and understand this is why the numbers are so lofty here. But over time, let's kind of watch the market. Overall, multiple prices, multiple offers have been up this year. This is sort of from 2017 to 2020, and you can kind of see, look at 2020 versus 2019. The market has been more aggressive this year. It's felt more competitive even during a pandemic. And so I think sometimes when I share stats like this and people, the knee-jerk response is they'll say, yeah, but the market is about ready to crash, or yeah, but forbearance, or yeah, but unemployment. And I know these are red flags, but that doesn't negate the competitive feel in today's market. Okay, so this should say 51.6%, by the way, but I've made an error there. But anyway, check out among current pendings, 49% since May 1st have more multiple offers. And so this is important to note. This number is hardly down, but what it reminds us of is that the market is a little bit softer right now in the pendings compared to the sales from April. Okay, so not by much, but it just shows that buyers have gained a little bit more power. Okay, now will buyers continue to gain power? I mean, we'll kind of see what happens in the future here, but important to watch. There's basically, when you look at multiple offers by price range, here's price ranges in going up, you can basically see that there's less multiple offers the higher the price, or that there's more multiple offers the lower the price. Now, this is a very normal trend. This happens in real estate in every market. And so it just reminds us so that the market isn't the same in every neighborhood or price range, and it's frankly not the same for every property type, whether Airbnb or land or 2 to 4 units, single family condos. There can be different dynamics in different slivers of the market. All right. Here's the second to last image, then we'll close. This is sort of the change days on market between April 2019 and April 2020. Let me explain how this works. Now, what I'm gauging is I want to look at especially higher prices. Are higher prices starting to slough? Well, we'll know over time as we compare, is it taking more or less time to sell compared to the rest of the market? All right. Now look, in every single price range this April, it took less time to sell. The whole entire market, it took about 29% less time to sell this April compared to last April. All right. And so in translated in days, it took 11 days on average less to sell a home in April 2020 compared to April 2019. But you look above a million, it took 27% less time, or 4 to 500,000, it took 34% less time. But by and large, the trend is that lower prices, particularly under 400,000, they went much more quickly than other price points. And this graph will be more meaningful when I add a few more months of data, but again, something to watch, all right? An X factor, the last X factor before closing thoughts is mortgage rates. Okay, mortgage rates are incredibly low. This image comes from Lundquist on Twitter. You can just see where 30-year and 15-year, 3.28%, 2.72%, these numbers are crazy. It's wild to see numbers this low. And that's like rocket fuel for today's market, okay? And so our market is very sensitive to rate changes, and when we see rates get this low, things get a little crazy. And so no wonder why it feels really competitive, even if there are red flags in the future. So some closing thoughts real quick. We need time to see the trend. We need days, we need weeks, and we need months. We'll keep watching this and I will keep reporting once a week. Okay, let's talk about both today and the future. Okay, let's be careful about sensationalism though. The danger is that if we look to the future and then we end up imposing the red flags on today's market, we might miss how competitive it feels out there. And so let's be careful too. For those who work in real estate, you can lose credibility if you embrace sensationalism and your predictions or prophecies don't end up coming true. All right. There's no market formula. What happened last time during, the housing correction isn't the new template for what happens today. And so the market does not have to behave in a certain way. And there's new layers of the market every single week that are being introduced. There's new things that we have to think through. Okay. We're in uncharted territory here. Last but not least, I'd say be safe out there. If you like this, please give it a thumbs up. I really enjoy getting to do this. Thank you so much. And please comment below if you want that woodworking piece too. If you guys like that, I'll have some more stuff next week to give away. But thank you so much. Appreciate the conversation.